Okay, so looks like we're getting there. All right, that's done. And now I'm going to open it up to everybody.
Okay.
You want to pull your slides up? Make sure they're working.
Sure. Here we go.
Excellent. And you are in slideshow mode, right?
Uh, Says I'm screen sharing. Let's see, slide control. So you're not seeing anything?
Yeah, no, I'm seeing it. I'm seeing
Okay.
it. It's
Whoop.
small, but yeah, no, but it's fine. It's fine.
It's small though?
It's smaller than typically I would see them, but I think it's okay. It's legible and clean. But you're in. So if you go down to the bottom of your screen on the right-hand side, there's something that looks like a slide screen. Yeah, if you press that, it should give you. You should be in slide mode. It looks like you are.
Is
Yeah,
that
you are.
better?
There you go. Much better. Yep.
Okay.
All right, I'm going to open it up for everybody. I'm going to hit start webinar.
Okie doke.
And then I'm going to turn it over to you pretty quickly.
You want me to tip it off here, Bob?
Yeah, I'll start it and then turn it over to you pretty quick.
Okay.
People are joining. So hi, everybody. I'm Bob Cohen. And as you join tonight, I want to welcome you. We are going to wait to get a few attendees on here. Another minute or so. That's 7:01. So at 7:02, we'll get started. I got 7:02. All right. Again, welcome. My name is Bob Cohen. I'm a SCORE mentor and happy to have you here with us tonight. This is the fifth of the series in simple steps to starting your business. Tonight, we've got Dan Toll with us. Dan will tell you his own background, but Dan is with the SBA and is a former banker, so he's the perfect guy to talk about what we need to talk about with funding tonight. Um, as you know, we've gone through, and I'd like to hear from you all too. Um, if you have sat in on any of the other sessions, let me know that in the chat and maybe which sessions that you've joined. This is the last of the 5, as I mentioned, and be curious to see. Just always remember that you've got SCORE mentors available to help you build your business and your business plans. And Dan, do you want me to take it through the first couple slides, or do you want to?
Sure. Yeah. I mean,
Okay.
either way, Bob, I think
Yeah.
we've kind of covered this a little bit here.
Yeah,
Um,
we have.
I
So
think,
go ahead. So you all know that SCORE's mission is to foster small business communities, vibrant business communities through mentoring and education. This is typical of the types of workshops that we do. And so, we do workshops and certainly we do one-on-one, two-on-one mentoring. All of our services are free. We're part of the SBA. We've got about 10,000 SCORE volunteers throughout the country. There's about 90 in the Cleveland area. Cleveland SCORE spans from Ashtabula on the east along the lake all the way west to Huron and Sandusky counties. So there's actually 7 counties that we service. Our mentoring is free, as I mentioned. I would recommend, if you get an opportunity, to go to the SCORE website, which is score.org/Cleveland, and you can find a local mentor. You can take a workshop, and there's all kinds of great resources available for you on this website. So if you're, putting together a business plan, which many of you are, otherwise you wouldn't be here with us tonight. There's templates on that. There's financial templates. There's a lot of information on how to find funding, and certainly we welcome you to request a mentor and have a mentor work with you and help you through your business plan. So I'm going to turn it over to Dan. Dan's going to talk to you about funding and funding sources. And I think you'll find this quite interesting. I know last week you were with Richard Brooks. Richard was talking about just general finance kinds of stuff. Before that, it was marketing. Before that, it was how to articulate and start your business plan. There we go. We've got all of it right there. So session one, startup basics. Session two was, articulating your business concept, marketing, and then financial matters last week. And now Dan's going to talk about funding sources. The idea of the entire process is to get to a point where you understand whether you've got a business that's viable or not, make a go or no-go decision, but certainly to help work with a mentor to help you build your business plan. So Dan, take it away.
Okay, thank you, Bob. Good evening, everybody. The agenda that we have tonight is just to cover the two basic kinds of funding, equity funding and debt funding. Just a little bit of background on what each of those represent, and then the types of funding that are accessible under each category. Since a lot of what gets done for startups from the funding side is in the form of loans, I think typically that it's beneficial to go through the loan approval process, and within this would apply to banks and whether it's the large national banks or community banks, as well as credit unions, and it would also apply from your point of view, whether it's a SBA-backed loan or not. And we'll walk through that. But again, what the approval process looks like, how the loan is evaluated from the lender's point of view, and then I just close with some recommended steps in general that may or may not be applicable depending upon where you are in your startup journey. So starting with equity sources, I've done this presentation for a while, and I've added some general comments as a prelude to both equity and debt, because I end up saying them anyway. So I thought it would be useful to have them on a slide. And of course, I presuppose no existing knowledge of this of these areas when it comes to presenting this. So this may be information that you know, or it may be new to you. But in general, what is equity? When we talk about equity versus debt, well, equity is basically the investment that you make in your business, either just on your own behalf if you're the sole owner, or jointly by you and any other co-investors that you may have. And at the outset of getting a business started, it essentially is representing the investment in your startup costs. And once you move past startup, the amount of equity in your business will increase as you realize and retain profits or net income, positive net income, and or as you make additional investments into the business, and then the equity account will decrease in the event that you take cash dividends out of the business, or you have net losses in the business on an operating basis, excuse me. So it also includes, and I include this second paragraph because sometimes folks forget this, and it actually accrues to their benefit to remember this when you're approaching a lender, that Equity includes contributions that are made to the business in a non-monetary form. It represents, it also represents essentially investments that you've already made, but they are prior to the formal commencement of operations of the business. So that when, as a rule of thumb, a lender may say, okay, we'd like to see, roughly 20 to 30% of the investment, the required investment in a business to get it going in the form of equity. You want to make sure that if you've already bought equipment, or sometimes you have, or real estate, or even what's called FF&E, furniture, fixtures, and equipment, that you just may have and you contribute to the venture, you should also include that, assign a monetary value to that, and include that as part of your equity, because it is. And so a lot of people tend to think, okay, what equity? That means if I got to put in 100, if the total cost is $100 to get started and I got to put in 20, that's not just cash out of your pocket. 10 of that may already be covered in the form of assets that you've already paid for and then are contributing to the business. The benefit of equity, of equity, third-party equity investors, is that it reduces the portion of that 20, in my example, that you have to contribute as the entrepreneur, the driver of the business. The downside of that is that typically the cost of that investment for you is that they not only get a share of the profits, they get a share of the ownership. And that typically at the outset, entrepreneurs want to have, would, in a perfect world, would like to have 100% of essentially the upside that they get to owning the business. But sometimes, it's either by choice or sometimes by necessity that an entrepreneur will bring in somebody else to help cover the costs up front, and then so that they can get the business started, which is the paramount concern. So what are the types of equity? Well, from an ownership standpoint or an individual standpoint, it's savings that you might have. It's sometimes folks draw on home equity loans. Sometimes folks draw on amounts available under personal credit cards, or if they are part of have worked for a company or continue to work for a company that has a 401k plan, you can get a loan against the 401k asset value. CVLI stands for the cash value of life insurance. If you have life insurance plans that you are, life insurance that you're paying for, policies is what I meant to say, that you're paying for, over time, you start to, the cash value of that life insurance builds up. And you can also access that to invest in your business. Then other unsecured loans that someone may obtain via other means, whether it's an unsecured loan from a bank or another source, that also kind of rounds out the fairly standard type of equity contributions that we think of. The other standard type, and it's very common, are so-called F&F loans, or friends and family loans, where or equity, where someone helps you get started. And in terms of having a third party as an investor, friends and family are often a good resource, because number one, they tend to be supportive, because they want to see you as their son, brother, or cousin, or whatever succeed, and that's a big reason. And so they'll be more patient typically as the process rolls out going forward. However, you want to make sure, and this is whether they contribute debt or equity to you, you want to make sure that you treat them as if they are third-party investors, unrelated investors, when it comes to the information that they receive, the information that you provide up front, and an ongoing basis. They are definitely more than an interested party, because they have a stake in the business, be it in the form of an equity or debt investment. Sometimes folks are also able to access other folks that they know through their professional networks or other networks. I mean, folks that they've known through church or something else may have an interest in either helping you or helping you because the business that you're starting is of interest to them. Crowdfunding is a newer, about a decade old, and is now actually formally regulated by the SEC. Crowdfunding is another form where essentially on crowdfunding sites, and they're available for both equity and debt investments, where you go onto a site like WeFunder, or there are others that will reference as well, or Honeycomb. You go onto that site and essentially you put up what amounts to kind of either a synopsis of your business plan. Sometimes it's the entire business plan, and identify the amount of money that you need, that you want to raise. And on crowdfunding, these are called campaigns, whereby you put forward the required information, and you specify how much you need and for what purpose, which will be fleshed out by the business plan, and then also indicate what increments of investment you are willing to accept. So for a third-party investor that is on crowdfunding sites, I've signed up on all of them just so number one, I want to see the types of businesses that are being funded there, but also I just like to see it from an investor's point of view. And so the dollar amounts can be as low as 100. They can be as high as 10,000 or larger. It just depends on the increments. Now, if it's from the equity side, those are going to represent shares of ownership in the business. So you may say that you are crowdfunding and the aggregate amount that you're seeking is going to be, worth 20%, a 20% investment in the business alongside your 20%, if that's what you're doing. But I still see it more commonly used on the debt side than the equity side, but it is used for both. Crowdfunding sites can sometimes have a particular angle, meaning that they are supporting and want to see businesses that have more of a mission-driven or social value investment, as opposed to kind of your Main Street business, which I think we typically think of at SCORE, for example, that we're helping, whether it's a plumbing contractor or a bakery or something that's getting started. They'll have more sort of esoteric businesses that they will also support. So it really just depends upon the site that you choose to utilize. But there are definitely sites that provide access for those Main Street kind of businesses. Angel investors, they are exactly what it sounds like they are. They're individuals that have a lot of money, and are called angels because they kind of come to the rescue and they invest in your business when you either can't find other forms of equity holders, or this is your ideal type of equity holder. So, for example, if you Google Cleveland Angel Investor Network, you will find sites that identify a number of, or for a cost, usually, a number of folks that have expressed their interest in investing in businesses, and they will have their profiles on that site indicating the types of businesses that they're interested in investing in. So, there's value there, because typically one of the most typical way that they have become high net worth individuals is because they've been successful in business themselves. So there's kind of the implicit advisory role in which they can function, and often they will want that kind of advisory role given the investment that they are investing in the business. And then the last type of equity source, which you may hear of in the media and the press quite a bit, is venture capital, which are essentially companies that are formed for the purpose of investing in startups. And when we talk about venture capital, it is more in sort of in common parlance, it more so refers to kind of new high-tech or life science products or innovations that have very good potential to scale, to grow and grow rapidly, and therefore yield a significant investment return for the venture capital investment group. So think about like Amazon or Silicon Valley in general. There are other mini Silicon Valleys in Boston, Chicago, even places. I mean, Austin is a growing kind of startup and venture capital um, locus, but it's not typically for Main Street businesses. This is something that supports innovative products with high growth potential, and typically often end up with the company going public, and that's how the firm that is supported by the VCs ends up returning large returns to those individuals. So when we talk about equity, most often we're talking about your investment or friends and family type of investment. Debt sources. Talking about debt in general here. When I go over in the next couple of slides, we'll go over the different types that are out there. It's important to understand that I'm not necessarily advocating one over the other, meaning that you're going to see everything from business credit cards to conventional bank loans to SBA-backed loans. Business credit cards will have a higher cost, but they require less information. They about your business, about how much you financially invested, these type of things. And so just because something is high cost, and when I talk about high cost, I mean in anywhere from 17 to 25% interest, doesn't necessarily mean that it is quote unquote a bad source. It just depends on what resources the entrepreneur has at the outset and what the circumstances are. For example, if it's proving difficult for me to demonstrate my concept in a way that attracts conventional lenders capital, I may say, okay, I'm going to bootstrap this, and I don't mind paying 25% interest for a month if that investment can get customers. And then that the customers that I attract in that first few weeks starts to build, and I start building a track record of cash flow that then becomes attractive to lesser cost types of debt providers. So again, I am truly presenting this kind of in an agnostic fashion, because again, it just depends what makes sense for you at the particular point in time. In general, and we'll see this as we go through the different sources of debt as well. In general, price, flexibility, the more generous terms on a relative basis tends to vary with the level of information that the lender has about the borrower. And specifically, that means as a lender's knowledge of a borrower increases, the terms of the debt improve. And again, walking through the examples, I'll be able to demonstrate how this is the case. So when we compare debt to equity, because a lot of people will think about it, if you're not familiar with it, people want to think of, so what's better? Should I do all equity? Should I do, mostly debt? Well, again, it depends, but debt is generally more favorable because a lender's not going to take whatever type of lender it is. They're not going to take any share of ownership in your business, and their returns, the returns that they require from your business, are fixed. And that's in the form typically of interest rates. So that return is fixed. They're not going to get more and they're not going to get less, but they don't get to participate in any upside of your business beyond that. Now, there are some exclusions to this. There's so-called convertible debt, which is often issued by venture capital firms to the startups that they are supporting, which constitute a debt investment initially, but which can be converted to equity at a later point in time. And obviously, it's typically converted if once the investment in the firm pops, meaning that the business takes off, and then at that point, the equity upside outweighs the return that's promised via the debt investment. So again, it's just sort of a yin and yang, but that's the generally the yin and yang between debt and equity. And that so-called you can, and you'll hear people say that an entrepreneur can leverage his or her returns, which is true, because every dollar less of that $100 that you need to put into that are required to start your business, every dollar less that you contribute, you essentially are leveraging the remaining amount because your upside is limited. Now, the converse to that, though, is that your downside is unlimited. So I think I said limited. I meant your upside and your downside are unlimited. So it's not it's not necessarily great all the time. There are risks to being equity holders, but the important part is that the debt holders return, which is their return for their risk, is fixed in most situations. So types, starting with the more costly, okay? Business or personal credit cards. I was just looking today, and I have a link at the back for, and I just want to say this now, I have a link at the back of the presentation for a link to NerdWallet, which is a fantastic site to visit if you haven't visited it, because they provide a lot of comparisons of different types of debt funding vehicles. For example, crowdfunding or other or online lenders. For example, is another one where they've got a very good comparison. They have the same thing, and I was looking at it today for credit cards. So what you can expect is if you, and just based on what I viewed today, because I wanted to make sure I was current, they are typically requiring the collateral, i.e. a lien or an interest in the assets of your business. That's not happening as often, but you can guarantee that you will be required to put forward a personal guarantee. So even though the credit card will be in the name of the business, you will be personally liable for that amount. And the interest rates run from anywhere from 17 to 25%, just in the ordinary course. If you start missing payments or default, those rates are going to go up substantially. But that's the going rate for having a credit card. But remember, if we talk about information, really all you're providing at the outset is your credit score. I mean, essentially, because you are indivisible from the business when you get started. So it's basically your credit score, maybe a couple other metrics about what the business does, or obviously, well, in credit card, you typically they don't even have a specified limit. It'll basically be dependent upon your credit score. So again, that cost is high because all they're looking at for the most part is your credit score and a few other variables. So they're kind of indifferent to what type of business it is. They're just going to look at, and after you get started beyond your credit score, they're going to look at your payment history, the payment history of your business with respect to the credit card. But that's all they're looking at. So when you're just looking at that information, when you're judging, assessing whether to make what it is in essence a loan to a business in the form of this of a credit card, your default rate's going to be higher because you're not getting any other information. You're not asking about the business. You're not getting information as to what other kinds of risks exist. It's just that very narrow framework of frankly what you look like personally from a financial metric standpoint at the outset, and then what your payment history looks like thereafter. That's why they charge the higher rates. That's the fundamental reason that you see these higher rates. And you always wonder, why are credit cards so expensive? That's why, because they're not getting any other information about the business. Same with online lenders, and there are some good examples here: On Deck, Fundbox, Bluevine. Essentially, and the same, and I'll cover lender marketplaces at the same time. Online lenders like On Deck, you can go onto their site. Whoops, I'm sorry. You can go onto their site, and it'll basically ask you, again, it'll ask you for a credit score. It'll ask you for how much do you need and for what purpose do you need to use the funds. Sometimes online lenders will restrict their funds to existing businesses. Other times they're open to any maturity of business, so they're accessible to startups too. But they're only asking, again, for a fairly limited amount of information. So what's the business? How long has it been open? Your credit score? What are you going to use it for? And then they'll either come back with an offer or they won't. In a marketplace like Lendio, Lendio has about 60 odd, between 60 65 different lenders that participate in their quote unquote marketplace. So you'll enter very similar kinds of basic information about your request, and those lenders that are interested out of that group of 65 will put forward offers. And those offers can take, various forms, various terms, various interest rates, but in general, the interest rates are going to be high because of the limited amount of information that you're providing. But again, to go back to being, non-judgmental about this from a cost standpoint, credit cards, online lenders, marketplaces, hey, if you're trying to get started, you may not care how much that interest rate is, because if it gets you over the hump, and then you can go to a lender, for example, for an SBA-backed loan, and say, hey, we're still new, but we're out of the gate and running, and here's my customers and my cash flow. Well, that's all you need to do to start to convert into more conventional financing, and what is then going to be a lower cost financing that we typically associate with loans to businesses. Crowdfunding, I probably should have included above invoice financing, but crowdfunding, again, is the same deal where you just go on and have a campaign for debt at a given interest rate. Typically, these campaigns will last for up to 60 days on the site. And if you have a target of $100, if you get $50 by the end of that 60 days, that's what you get. So again, it's just putting, and the requirements for information differ by site. These do differ because they will require more information of you, but their interest rates, the interest rates that you can seek, are lower because of that. Invoice financing, factoring, and equipment leasing. This is kind of once you're up and going, but again, it's a way to access cash quickly. For example, factoring is a form of debt financing because they don't take an interest in your business, but a factor essentially buys the accounts receivable that you have from your customers at a discount in order to provide the cash to you faster than you would otherwise get it. So for example, you won't have this issue if you're a retail business and you get started and you're using credit cards as a form of payment, which is very common. Credit cards are also a form of factor because they do take a discount. They charge a fee, but it's much smaller than a factor would charge. So using the factoring example, say I'm a manufacturer of the good old widget, whatever, a product, and I sell to a business customer. I'm B2B, and I sell to a business customer, but that customer requires terms of what's called net 30 days, meaning that they get 30 days to pay, which is fairly common in business to business commerce. So that's good. The good part of that is you have a customer. The bad part of that is you still have to keep your business afloat for 30 days. Where a factor steps in is they will look not at your risk, your business's risk as a startup. They look at the risk of the customer that you're selling to. So if it's an established business, obviously the Fortune 500, like Coca-Cola or whatever, they will look at the credit risk associated with the business. And if it's a typical of your customer, and it's typically going to be far less risk than you represent, so they will buy that receivable from you for 80 cents on the dollar, sometimes higher, 90, sometimes lower, depending again on the credit worthiness of your customer. The advantage to you is that they'll buy it in 5 to 10 days from the creation of that receivable. So you get your cash faster, which means you can plow it back into producing for the next customer, or covering, if you're a service business, covering the cost of your employees for an additional amount of time while you continue to try to ramp up business. So that's what factoring does. Invoice financing is very similar. It's essentially, if you get an invoice from a customer, you've sent an invoice to a customer, they'll buy that invoice from you or finance that invoice from you based upon, and provide you with the cash at a discount based upon the credit worthiness of the customer. Equipment leasing I just mentioned because when you start a business, cash is everything. Cash is not only king, it's everything. So having cash on hand, liquidity is vital to your survival once you get started. Well, equipment leasing allows you to keep more. Sure, you could buy that equipment. You could even maybe finance that equipment and put in 20 or 25% of the cost and finance the rest. But equipment leasing allows you to put nothing in up front and essentially amortize the cost over a 3 to 5 year term, sometimes 7, depending on how long lived the equipment is that you're getting financed. So there's nothing better than not getting access to an asset that can help you generate revenue while you are deferring the repayment of that over a much longer period of time. And frankly, you get 30 days typically with equipment leasing because it's typically monthly payments. And the other benefit of equipment leasing is they're only going to come bother you if there's a default. If you don't pay, within your permitted cure period or acceptable, whatever. Like with mortgages, typically it's due first of the month. Most mortgages will give you 15 or sometimes 30 days from that time, and that will be considered an on-time payment. Equipment leasing wouldn't bother you if, for example, you had a bank loan and you started defaulting. The banks are going to start talking to you. They're going to require changes in terms, other kinds of things. So equipment leasing is very straightforward. As long as you pay, you get to play. And I mentioned this in case, and I just ran out of room on the subsequent slide, so I included it here. There are other local, and I preface this because we're going to be getting to banks, both conventionally financed and SBA backed in a moment here. But there are other local economic and community development organizations that will provide funding to startups. In Cleveland, there's ECDI, for example, which I believe has obtained the mandate to provide what used to be called the community advantage loans that are SBA backed. And so that's an example that you can look at. And I have a link to their page at the back of this presentation, but ECDI is a good example of that. If you've been turned down for conventional financing and you still want to try to avoid going to these higher cost sources of debt that I've outlined, for example, there's an institution called HFLA of NEO, which is based in Beechwood here, where if you can demonstrate that you've been turned down, they will give you a 0% interest loan up to $10,000. And I continue to hear rumors that they've actually increased that, but they haven't changed their website to indicate it, which leads me to think that they haven't actually changed it, because I would think that would be the first thing they would change in terms of attracting borrowers. But in any event, $10,000 when you're starting up, depending on your situation, is nothing to sniff at. And so if you can demonstrate that you weren't able to get credit from other conventional sources, HFLA it has an application right there online, and you can tell your story to them and see if you can access capital on very generous terms. So debt sources. First, again, let's talk about friends and family. Always a source of debt as well as equity. With friends and family loans, as with when they are part investors in your businesses, you want to treat them as if they are third parties. Meaning, just because it's Uncle Joe, you don't want to take advantage of Uncle Joe. You don't want to assume he's just sort of in for the ride. Treat him professionally. And if he's going to loan you money, make sure there is an actual promissory note, the same kind of note that you would have to sign if you owed money on a mortgage or any other kind of debt from a bank. Make sure there is literally a promissory note that specifies when the amount is due, what the terms of repayment are, what the interest rate is. Even if you would hope it's a little bit lower than you can get elsewhere, that interest rate, you still want to have it specified, because that says to Uncle Joe that I, Dan, as the borrower, I mean business. And, I'm not going to take advantage of you, because the thing you want to, the potential issue with friends and family loans is that if things don't work out, and let's face it, a certain percentage of the time, startups do not work out. So if you have treated him professionally along the way, meaning that you didn't just take the money and a year later come back and say, oh, I'm out of business, sorry. No, you've kept him, in this case, up to date. You kept Uncle Joe up to date on how your business is doing on a monthly basis at least. And sort of anecdotally, you can certainly give him a call and say this, and this. You're providing him with financials as you go, so that at least he, in this case, Uncle Joe, isn't surprised. And it's not like you just kind of ghosted him after you got the money and then sort of said, sorry, out of luck, I did my best. That can lead to, not in every situation. Some friends or family will say, yeah, I knew the risk. That's the deal. But others, sometimes that can get a little acrimonious. And you would hate for there to be strains with friends or family based on this transaction. So just a caution to make sure you formalize it, because it's good for everybody, including you, if you do it that way. All right, let's talk about more the kind of the conventional sources of financing that we all kind of think about as there, right? That, okay, a bank loan. Well, bank loans can be either, just a loan from the bank that's not supported by the SBA in any way. And that just means you go and apply at, the local community bank or credit union, and they tell you, again, you're going to provide them, we'll go over this later, but you're going to provide them with a business plan, et cetera. And they come back with sort of yay or nay, or yes, but with some changes from what you want, that type of thing. That's very conventional. And, and depending on the situation, if you put together a business plan, which I do recommend, because it helps you with the guideposts as to how you want to proceed as well, keeps you on track. If you put that business plan together, you might as well give banks and credit unions a shot, because they might say yes. And even if they don't, their saying no is the key to accessing SBA-backed financing. So kind of, I got my bullet points switched around here, but because I've run into this situation talking with folks that sometimes how the SBA functions is not clearly understood. The SBA is not a direct lender. It was during COVID with PPP loan, actually with EIDL loans and PP loans through banks, but it was essentially the SBA. The SBA was a 100% guarantee, and then it came back to them if a borrower defaults. The SBA is not a direct lender. You don't go to the SBA and say, hey, can I get a loan? What you do is you go to a bank that has the capability of providing SBA bank loans, which is typically going to be, if it's a large bank, it'll be called their community banking or business banking group. Typically, sometimes they'll just have an SBA group designated. It depends. But so to access the programs that are outlined here, you have to demonstrate in every case, and I'm a credit officer on the 504 program for the SBA, so I look at applications every day. And in every application, you're applying through the bank, So the bank will basically, it'll have information that it wants, and then they will provide you with the forms that the SBA needs to see as well, because they forward that application on to the SBA to get a portion of their loan guaranteed. Because you are riskier because you have not been able to get credit elsewhere. And that is the essence of accessing SBA financing, is demonstrating it's the so-called NCE test, or no credit elsewhere test. I have to prove that I was not to the bank that's going to apply to the SBA for support. I have to prove to them that I couldn't get that conventional loan that I wanted. So that's a denial letter. It's something you can get the bank to codify something if you have approached them for a conventional loan, that, in writing, that demonstrates that you were unsuccessful. Typically, though, if you're a startup, and that's what we're talking about here, you'll go straight to the SBA supported loans. So what is it? I mean, so you got to satisfy that test. You have to be able to tangibly demonstrate it. And it comes through on the application as kind of, okay, you weren't able to access loans in the community where the financing sources are, on the terms and conditions that are commonly available. Okay, well, with being a startup, you don't have to demonstrate much, because you are a startup. You are risky. The only kind of scenario which would be different typically is if you have where you might be able to get conventional financing, is frankly if you've got a lot of money on the side. So if you're looking for a $100,000 loan or $250,000 loan from a bank, just conventionally, if you've got, $500,000 available in some other account that's not a retirement account, meaning that it could be accessed if there was a bankruptcy or something, then then you're likely to be able to get conventional bank financing. The problem is that's not true for most of us. We don't have that amount, and that's why borrowers will often complain that banks will only lend money to you when you don't need the money. And there's a little bit of truism to that, because at least certainly in the case of startups, sometimes with existing banks as well, where lenders focus on the existing cash flow. But for startups, if you're not going to have the money, or you would have already put it in, meaning sufficient money. So let's operate off the premise that we are startups, and that alone, because there's actually a sheet, and there'll be several conditions stated that just as a default on a form. And what the bank does is literally check the box that applies to them. Maybe it's the collateral would be called what's known as special purpose. So if you're starting a bowling alley, for example, that is called, gosh darn it, called special purpose property. Okay, because if the lender has to take that back, it's not likely, the chances of finding another bowling operator to come in and operate that business after yours failed is very low. So the bank would have to put, or anybody that buys the loan from the bank or otherwise buys the property, if they want to put that into some other use, you've got to invest a lot of money, because there aren't many offices with bowling lanes in them, unless it's, I think, the White House. That's about it. So that's what special purpose property is. The startup alone, or for example, in business less than 2 years, is often a criteria. So you're not going to have to worry about accessing the SBA guarantee situations as a startup. So what that means, what is an SBA guarantee? It essentially says, depending on the program, that this, and sort of why it happens, is the SBA is an economic development tool of the federal government. It is, it's basically, again, permitting credit to be extended to companies that would not otherwise get it, but for a partial guarantee of the principal that the bank is lending. So that guarantee, depending on the program, can range anywhere from 50% to 90%. So it's not a insignificant amount for a lender, and it's intended to be that way, because they're trying to incentivize the lender to make the loans to these customers that they wouldn't make conventional loans to. There's different programs. The largest is the 7A, and it's more for than just working capital, which is typically in the form of a line of credit. It can also be a term loan, but often in a line of credit to support ongoing, basically gaps in your cash flow when you need to pay expenses and you don't have a sufficient amount of money coming in at that moment, and you've got to, say every 2 weeks you got to pay paychecks. That helps you cover the gap. That's what a working capital line is. There's other uses too, but that's one that it's easy for people to picture. So 7A will also do real estate. It will also do equipment. And the maximum amount of the loan that they will guarantee is $5 million. And the most they will guarantee is $3,750,000 of that. So because they have a specified percentage above which they will not go in terms of their guarantee. The 504 program that I work on, the maximum loan amount is, boy, I got to stop doing that. Maximum loan amount is $5.5 million. What makes the 504 attractive, and it's only for real estate or equipment, is that as a startup, your equity requirement could drop to 15% of the loan amount. So if you need a piece of real estate to get going, which is sometimes the kit to own, I should say, to own. I would always recommend renting unless it's something that is you need to control for whatever purpose. But if you need to own it, you can put in as little as 15%. For an existing business, that can be as low as 10%. But the SBA adds an additional 5% equity contribution for a startup, and that's the definition of under 2 years in existence. And they add another 5% if it's special purpose, like a bowling alley or a school or gymnasiums. There's all kinds of golf courses. So they'll add another. So up to 20. The max you would have to pay in is 20%, which is still a fairly low amount in all consideration. So the 504 program, community advantage loans, that was all of these things you can very easily look up on the SBA website, and it will talk about the features of each program, maxes, minimums, interest rates, the whole 9 yards. So I won't go into it in a lot of detail here, but the Community Advantage program was a pilot program for lower dollar amounts, and that pilot was recently terminated, but it was only terminated because it typically is for these mission-oriented, community-based lenders that I talked about. They are often chartered to provide these loans. And the reason that it was terminated is because a whole bunch of these mission lenders received an accreditation from the SBA, which essentially sort of elevates their status to an approved SBA lender. So it still exists. It's just in a different form. And then there are microloans too, where you can get up to 6-year repayment time frame on up to $50,000. So that kind of covers the SBA. I wanted to get into that a bit because, outside of the higher costs, and now I am doing it on purpose, these higher cost sources, the SBA program, if you're going to try to get it done through a bank or a credit union, they are typically going to be doing that with SBA-backed financing. So let's talk about the approval process. You gather your information. We're going to strictly go into the domain of let's just say SBA-backed financing here. So, but it would apply to conventional loans too, bank loans. You're going to gather your information. That's typically your business plan. They're going to ask for a personal financial statement from you, which is kind of your personal balance sheet, what your assets are, car, house, whatever else you put on there, and what your liabilities are, student debt, mortgage, car loan, whatever it is. They'll ask for your tax returns, and usually they'll ask for a couple years of it. They'll ask for financial projections. That's typically included as an appendix to a business plan or incorporated in the business plan. And then this is an important thing that you'll provide the dollar amount that you want and your sources and uses of the funds that you are going to provide. A lender likes to start from a sources and uses table. And you can think of it as like drawing a T, and on the left side of the T is the sources. So in that $100 total startup cost that I have, I'm putting in $20 and I want $80 to come from the lender. Well, that's the sources side of that T. On the uses side, and this is what's really important, are how you're going to use it. And this kind of sounds basic, but it really kind of outlines what a lender needs to know. And they are extremely common, even in, I mean, sophisticated, much higher levels of, much larger businesses, more sophisticated lending. You'll see sources and uses tables all the time. So those uses: buy real estate, buy equipment, put away 3 months of, employee expenses, kind of working capital expenses. It can be whatever your costs are. And that's where, again, I want to go back to, it's important to know what costs you've already incurred before the business starts so that you don't underrepresent what you've invested. Like I say, so your 20% can be a true 20% and, represent not only when you're investing at the time that the lender comes in, but what you've invested previously. So you'll identify a group of lenders to go to, and ideally try to set up meetings with the lenders. Now, this has become harder to do with the national banks. The good part of the national banks, so, I used to work for Wells Fargo in town. Wells Fargo has a small business group working in Northeast Ohio and Pennsylvania now, but it's not very robust. So think of Key, obviously Key based here. They have a, they're a large, they're technically a regional, but they're a very large bank that you would want to access. Huntington is one of the top 10 SBA lenders in the country. So that's another large bank that you might want to think about. However, when you access these, unless you know a banker personally or your friend Bob knows Chris at Huntington, you're typically going to go to, they'll direct you to go to a branch and you'll get the application forms and then return them to the branch manager. And the branch manager will have a slight clue about lending, but not much more. That's going to get forwarded on to the SBA group, who will later contact you, but that's already after they've seen your information. And you don't have the opportunity to present yourself, which is very important. It's why I often recommend to folks and to startups to look at the community banks and look at the credit union. They are, it depends on your dollar amount. The capital amount of capital you can get from a credit union is going to be kind of capped off because these are not ginormous, lenders. They don't have a big access of capital base that they can use to make loans. But if you're in that, you're under $1 million, you're 250, you're 500, go to a credit union, because the reason I say that is because you can get a meeting right across the table. And there is nothing more valuable to the process than not just being a piece of paper that gets submitted. Sometimes there's no choice. But if there's any way that you can differentiate your business and you from just being a piece of paper, it's to your advantage, assuming you don't, curse at the lender that you're meeting with or something. That is a beneficial process. And at the credit unions, I know for a fact that there'll be a relationship manager, account officer, maybe a few, some cases just one, who basically fields your inquiry. And then there's 2 other people involved in the process. So he or she is in there, representing your business based on what she has gathered from you personally. It's an advantage 99.9% of the time relative to not having that. You can also seek what are, called warm handoffs as opposed to cold contacts, going in cold. I'd still recommend going in cold to the credit union, even if they don't know you before they get you. But for example, at SCORE, I can provide, if I recommend a lender, I have to recommend at least 3 But I'm always going to include in that list a credit union because I know the people at some of them, and I will say it to each of these contacts that I'm sending I'm sending these folks your way. And that's a way just to say, okay, I know Dan, and Dan's talked to these folks and he hasn't put up a stop sign. So, this is, maybe it's a little more qualified than it might be, again, if you're coming in cold. Um, Again, if you can get a meeting, you know, practice your presentation, pitch it, and ask questions about the bank or the credit union and its process. Who gets involved? How long? And what's that mechanism? Those are the things you want to know, because a lot of and again, it's so much the value of getting to people personally is you can hold them accountable. Because if somebody says, I'll get to you in a week and a half, and it's 3 weeks, you're going back to Jane and saying, hey, what's the deal? Come on. Ideally, if Jane is a good lender, Jane has kept you abreast of what's going on. And so you're not surprised. You may be a little disappointed by the timing, but if it could still be, lead to a yes, it's still good to know. Nobody likes to be, ghosted in those scenarios. So ask questions. It not only gives you useful information, it also, shows that you are interested and that you are attentive to what's going on. You're not just forking up a document and saying, hey, this is going to be great. Trust me. You're pitching the selling points. They're getting to see you, because I don't care what's on paper. At the end of the day, and I'll be repeating myself, hopefully with less time in the loan evaluation process, but you are the business. Okay. If it is a you, or you and your wife, or you and your buddy that are starting this, you are the business. When that thing starts, I don't care what's on a business plan. You make all of that happen. So there's, that evaluation of you is important, and you want to be seen. Not only is it for your own benefit, but you want to be seen as somebody who is interested, attentive, committed to the process. It's all good. And again, the one caveat that I always say here is, make sure they know the risks, and that's in your business plan too. Very few people put risks in their business plan. You should, because the person that you're handing it to, or the institution that you're handing it to, all they care about is the risk. They don't want, all that good stuff. That's great. Tell me how I'm not going to get my money back. That's the first thing they're thinking of. I should have given you my background, but I've been in the lending business for about 30 years now. It's kind of frightening. But the last 10, the first 20 plus were with banks. And I was senior credit officer for Wells Fargo for their middle market banking in the state of Ohio. And the last 10 years, I focused more on small and medium-sized businesses, first as a consultant to borrowers, and then I joined the SBA 3 years ago, and that's all we see is the small, mostly small, some medium-sized borrowers, or SMEs as they're called. You come across as professional and wise, and frankly, somebody who is savvy to what's going on if you say what the risks are with your business. Here's why I think my business is I actually prefer start with the risks. Because as a startup, there's all kinds of risks. Why this thing, you don't get a customer doesn't walk in the door, you have a problem. Why is that going to happen? And if you state the reasons why you think this is a risk, and then all that good stuff you've got in the business plan that talks about how you're going to market, who your market is, why your business needs to exist, all that stuff. Those are the mitigants to those risks. I mean, essentially, lending boils down to one big paragraph about risks and mitigants. That's it. That's what it's distilled to. And if you don't have an answer to a question, don't make it up. Don't, sort of like, this, I have a question about this or that, or I'll, just say, don't try to put forward something where somebody can clearly tell. And believe me, we can always tell. Just say, I don't know, because nobody's going to know the answer. I mean, somebody might come up with something that you and I could objectively agree is pretty harebrained to ask. but they're still asking the question. So you're going to need to come up with an answer for it. But you can say, Chris, I don't know right now. Can you give me about 48 hours and I'll get back to you on that? That's all you got to do. And you're much more credible. You don't want to blow that credibility, because as soon as you start blowing smoke and people perceive that, then all of a sudden they start questioning all that writing in the business plan too, unless it is appropriately backed by data, which can't be controverted. The approval process, so there's going to be at least 2 people on your deal. They're going to spread your projections, which is basically just putting it into income, like their form of an income statement and a balance sheet. And then what happens is typically they have a software program which will generate the ratios and coverage ratios, like debt service coverage and debt to equity ratios and those kinds of things, to see how much leverage is in the business. Spits out all those ratios that lenders like to look at. They will essentially, they'll review all the information you provided. Sometimes they'll do their own due diligence on it, and essentially they're going to prepare a credit memo. And most institutions, all institutions, have their own form for that. But basically, what it boils down to is kind of a reformulation of your business plan, because that's where they're getting a lot of the information from, or via any questions they've asked you directly, and then they're going to reformulate that into a way that a lender looks at it. So they're going to put forward that information, and then they're going to say, they'll conclude or open. At Wells Fargo, we opened after an introduction with what are the risks and mitigants, but they'll say, it'll show from their standpoint, conclude with what the mitigants are to any risks they've been identified, and therefore we should get approval. And then there are 2 kinds of processes: signature and committee. The credit union example that I gave, the specific one, there's 3 people involved, including the account officer that people meet with. And they meet on pretty much an ad hoc basis, meaning it can be any particular time when they have a borrower request to look at. Larger banks, if they operate on a committee system, it will be committee meets on Tuesdays and Fridays. And so again, this is part of what you'd like to know, if you can, before your information gets put into the process. Not that it makes a huge amount of difference, but from a timing standpoint, it can help. Because the nice thing about committees, and I've worked under both as both an account officer and a credit guy, and there again, like anything, there are benefits and disadvantages to them. And the committee process, the good thing is it meets. The potentially negative thing in there is that there's might be a standing committee of people that are not like that 3-person committee at the credit union. There's people in there that don't know anything about it. They may even be from other lines of business. I used to participate in one where the chief credit officer of the bank, and a large bank in Chicago, was part of every meeting. Well, they're going to bring other agendas, other ideas into the setting that, really may not be germane to your request. To be blunt. So sometimes your audience may not be, the one that you would like to have. Signature loan authority, on the other hand, which is how I operated on when I was with Wells Fargo, I had approved loan approval up to a certain amount. So I could sit and which would have covered what most startup requests are. So I could sit there, if you met with me, and that was an absolutely critical part of our process, was getting the so-called credit guy or gal out to meet with the account officer with the customer or potential customer, because credit officers can't make good decisions behind a desk, and they need to see the people too and kind of feel it, just get that perception as well. Anyway, that's always a nice process, because you may be meeting with or know about or have some insight into the person that is going to approve or not approve your loan. The other thing is that signature loan authority, depending on how the institution works, but at Wells Fargo, it was designed to provide quicker feedback to borrowers, because it just requires an individual. If it went above my authority, there's just one other person that I need to go to who covered things on a broader regional basis. But it's one person, and it's literally me sending him or her some information and setting up a phone call. So the feedback can be quicker. And that's why we liked it. It was a little more customer friendly. On the other hand, if you're the loan signature loan authority, the person that signs on the loan to approve the loan is out of town for a few weeks, that can screw up the process a bit, because then you've got to bring in a proxy approver from somewhere else, and they don't really want to approve it because it's not going to be in their bailiwick going forward. So they may not feel as comfortable. But anyway, these things meet when they meet or sign when they sign. They communicate the outcome to you and then provide you with what's called a term sheet, which is just an outline of the terms. Then you may or may not want to negotiate. Typically, startup businesses aren't going to do a lot of negotiating because, unfortunately, you don't have a lot of leverage from a negotiating standpoint. But it does happen. If the lender needs to, after that term sheet is issued, it'll say if there are any conditions that the approval is subject to. If you're buying real estate, for example, well, it's going to be subject to an acceptable appraisal that shows basically that the amount of the real estate is what you think it is. Third-party appraisal, and there'll also be like an environmental investigation to just make sure that a bunch of chemicals weren't dumped on the site that you're either building or buying, because when you buy that property, you become liable for that. So it's in your best interest to have that too. And the lender becomes liable too, which is the reason why the lender required. But at the end of the day, there's no mystery here. I mean, that's it. What I just described to you is it. It's a very simple process. They reformulate your business plan. They've asked you some questions. They do a little research. They put it all together in their credit memo, and then forward that either to committee, and then they go into the committee and represent it, or it goes to the credit person in the office, and then he or she either adjudicates it or talks to somebody else for the adjudication. Evaluating. Two fundamental questions that this may or may not be news to you, but when a lender's evaluating a loan, particularly a startup loan, anybody, this is true venture capital, it's true in any situation, even a third-party equity investor is going to be asking the same question. There's these two questions. Why does your business need to exist? What gap in the marketplace is it fulfilling? Essentially, why will you have that customer in the first week or the first 2 weeks? What's going to make this, and you're going to address that in your business plan. And Lord knows, I mean, SCORE can talk to you about putting business plans together, the mentors, and there's also, there's also articles, probably a webinar or so that's on business plans, and it's worthwhile, because what you want to make sure is that there's data in there, empirical data, and not just I think, okay? I think this is good. I think the market is, well, it's good to get your opinion, but it's not unusual that you think such and such is going to appear if you're going to operate a business to serve that market. If you can get some third-party validation of that for your data points, your target market, or these days they call it TAM, or total addressable market. How many people are out there? How many businesses are out there for what you're going to do? And then the second question you have to answer, which is, sometimes people don't think about, is why are you the one to do this? So typically, and the SBA does, the SBA is going to look for experience that you have. Ideally, maybe you haven't, you want to open a bar and restaurant, but you've just worked as, heck, you could be a waiter, you could be a bartender, but it still allows you to see the ins and outs of the business. So you have experience in the realm. And and so, that doesn't necessarily, experience also includes how you are experienced or capable to manage a new business too. And those are two different things. So you've got to address that. And yes, people who have not been in the business previously can get SBA-backed financing, but it is a steeper hurdle, okay? Stepping back, about 15 to 20% of the applications that the SBA approves for its guarantees in a given year, about 20% are for startup businesses. So it's a not insignificant percentage. Frankly, much higher than I thought it would be when I started. But it makes sense because, again, the SBA is an economic development tool. So they want to see that business creation, job creation. And so again, you're in where I'm leading to with that is you want to make sure that you've included a resume with your business plan because they're going to ask for it. And you're going to want to have narrative in your business plan. If I can't directly trace why you, and there are people I've worked with, teachers, college professors that have started a bakery, and not at SCORE yet, but and actually for this person, it was another context in which I interacted with them. Another lender had extended credit to them, and it wasn't working out too well. So that's how I got involved. But it was a situation where this person loved baking, loved the product, but she didn't love marketing. So if you don't love the customer and you're a startup, you're done before you start. You can just bake for the kids and the family and your friends and come over on Super Bowl. But if it's for customers, you got to be passionate about getting to customers. And I understand. I mean, not everybody wants to be a marketer. I mean, it's, they want to be able to, just sort of say, okay, I'm going to build it or I'm going to bake it and they will come. But it just doesn't work that way 99% of the time. And that's where, her business was running into issues and she was open about it. The problem is to get that loan repaid, you're going to have to do something about it. So again, so the why you in her case, as I told the lender, I don't think there was as strong as a why you case there to be made for that particular startup. And, but again, you provide a resume, and I have recommendations at the end of this, but they include, basically learning as much as possible about the business you want to go into if you haven't done it already. You can mitigate that experience factor through certifications, interning, or after hours, or volunteering, or again taking classes, whatever it is. You can help to mitigate that risk by increasing your knowledge base and then focusing on whatever it is you do now. Talk about the skills that you've got. And that doesn't even have to be the meat of what you do. Talk about what is transferable. Is it, critical thinking, analyzing numbers, whatever it is that's going to be applicable to you running a business from the get, you want to point out. And again, if it's not going to be running the exact kind of business I'm starting, talk about those transferable skills, talk about the knowledge you've gained in the process to help mitigate that risk. 5 C's of credit, getting into more specifically about how banks look, try to go through this kind of quickly here. This is this rubric or name is saying has been around since the 1950s, but basically that credit memo is going to cover these 5 categories: character, capital, capacity, collateral, conditions. Okay, that's exciting. What do we mean by that? Character, well, it'll be your personal, and if you've had a business, your business credit history. It's important to lenders because they want to know how you've treated your obligations in the past. And if it is, everybody gets, the apple cart gets turned upside down by life events all the time. I see this with SBA applications. Personal bankruptcies can be mitigated. Business bankruptcies, if you started a prior business and it didn't work out, can be mitigated. Happens every day. You just have to provide the explanation for it. Hopefully your explanation is, yeah, it wasn't working out, so I handed the lender the keys and walked away. Because what lenders say, and it's kind of a general rule, is if they walked away before, they'll walk away again. And there unfortunately is some data to support that. So that doesn't just come out because lenders want to be mean. It's because there is some relevance to that. Conversely, people with steady payment histories or have explanation for, think missed payments or this or that or the other thing, as long as you can explain it. I mean, I got divorced. I mean, I can't count how many people have been turned upside by a divorce. Other things can happen, job loss in a particular situation where everything had looked real rosy before that. Those kinds of things can be, mitigated, and they are understandable. So don't be afraid of that. It's not a reason not to go forward with your plan. But if you do, the better credit history you have, the better outcome you're likely to receive. Character can also mean like your resume. Okay, so industry market experience, professional experience. Character is also in the sense of like, okay, who you are. Are you, hey, I hate to default to, are you a good guy or gal? But there's a little bit of that. I mean, people are going to perceive from how you present yourself. People can perceive things. I mean, you can read the literature on, how people make judgments and how they make assessments that, these things happen in as quick as 7 seconds, which isn't always fair or accurate, but it just reflexively happens as human beings. So, not to say that would necessarily carry through to a loan denial, but just, if you have references, somebody to say, yeah, Dan's not running around up and down the street, streaking or tearing down houses, he's a good guy, that kind of thing. That helps. And it just, again, third parties, everyone will understand that you're probably not going to pick somebody like when you're getting a job. You're not going to pick somebody who says, yeah, he was lousy at his last job, maybe he'll do better with you. But, nonetheless, it helps with the character part. Capital, we've talked about. That's equity. Cash, assets invested in the business. Lenders, as a result, there will be and if you get a loan, if you don't get any loan, you're 100% equity, right? If you get out of that $100, if, and I do 20, well, you're leveraged 4 to 1 because you're 4 times debt to equity if it's 80-20. And then capital also has to do with earnings retention versus dividends. And this is important for one reason. When we're talking about dividends, a lot of people will not pay themselves, right, when they're getting started because either they can't afford to or they choose not to. They've got vital employees that they need. Maybe it's 1 or 2, but they need to keep those employees paid, and they'll take the hit, because they believe the business is going to be successful. That's great. What you don't want to do, particularly when you're repaying a loan, is start taking a lot of money out of the business, what's called so-called below the line, like dividends, the same kind of dividends you would get if you own a share of Coca-Cola and it pays quarterly dividends of X amount per share you own. You take it out not in salary, which is an expense above the profit line, but you take it out in dividends. You dividend yourself money, which comes right out of equity. And lenders in general, unless there are more extraordinary circumstances involved, want to see 100% earnings retention for a good while. Because number one, the business needs it. Again, cash is king. You have to have it. You don't have it. I mean, lack of liquidity kills businesses. I mean, it sort of de facto makes sense, but the lack of liquidity, you're running into a liquidity crunch that you didn't expect because somebody doesn't pay you on time. That can kill a business. I mean, in more, exaggerated circumstances, it can kill a business. So they want to see you keep as much cash in the business as you can. They'll understand that, you want to pay yourself at some point. And if you can comfortably do that from the get, that's fine. But leave enough, money and profit, if it's a salary, in the business that net income that you're showing, the amount of that net income can cover the required debt service that you have to pay by 1 to 2 times, or excuse me, 1 to 1 point, boy, I'm blowing this, 1.1 to 1.2 times, more like 1.2, 1.25 times, so that there's some room. So you're not operating right at break even relative to your debt service. Capacity. Speaking of cash flow covering debt service, capacity is the ability of cash flow to cover your required payments. And that's typically your required payments are, of course, Uncle Sam, and then the debt service that you owe to the bank. And this will be assessed at the outset and on an ongoing basis. So typically, I'll cover the 2 bullet points before I make the point that I want to make, but it's reflected in profitability, but your profit is not the same as your cash flow if you're on accrual accounting versus cash accounting. If it's cash accounting, it's going to be the same thing. Cash coming in versus cash coming out. under GAAP accounting, under traditional accounting, a lot of businesses will opt for accrual accounting where you get to recognize revenue earlier, for example, because all the conditions necessary to generate that revenue have occurred. So, for example, on the 30-day terms thing, I can say, well, I've realized a sale today. I'm not going to get paid for somewhere between now and 30 days. And so that will create what's called an accounts receivable. And then that will run through as cash, but I'm going to recognize the income now. Because if I always waited till the cash came in, you kind of have a very choppy picture, sometimes even on a monthly basis. And it doesn't truly reflect your earnings capacity. And that's why this little acronym down here called EBITDA, which stands for earnings before interest, expense, taxes, depreciation, and amortization, which are related to which are non-cash expenses, depreciation in particular, which represents kind of the, for example, equipment in particular, also real estate. You can depreciate it over a much longer period of time, but it basically says, like this equipment is no longer new with each year that goes out. So it's depreciating from use or whatever over time. So the IRS will say, okay, you can depreciate that over 7 years. And actually, as a small business owner, you're going to love depreciation, and you'll often seek to maximize it because you want to show as little income to the IRS as you can. And so when lenders look at your tax returns, they will understand that if it's if it's a cash or accrual. But reducing your amounts due to Uncle Sam, which is also why you could organize as a limited liability company or an S corporation where you are not taxed at the corporate level. So then it's just your share of the earnings, which could be 100%, get taxed at your personal level, and therefore that tax rate may or may not be more advantaged than having it taxed at the corporate level. But anyway, EBITDA stands back and says it's an accrual-based measure, or it's at its best when it's accrual-based measure, because EBITDA will include that sale you've made, irrespective of whether the cash has come in yet. And what it does for a lender is says, okay, I know the cash isn't there yet because everybody demands terms, but it's a reflection of the earnings capacity of the company. And that's why a proxy of cash flow is often used to, as used as sort of the numerator over the debt service to see like, okay, here's what I can pay. And can I cover it 1.1 times or 1.25 times the debt service? You're going to want to have some surplus in that debt coverage ratio. Because again, if you're just 1-to-1, well, that's good. Your earnings capacity is covering the payment, but you got no room for slippage, and there's always slippage.
Hey, Dan, Dan,
I'm
Bob
sorry?
here. Sorry, we're gonna have to wrap up quite
Oh,
quickly.
geez, I'm sorry.
Yeah, it's 8:30 and people need to sign off.
Can I go through this real quick?
Sure.
Collateral, I think everybody understands collateral. It's the assets that you put forward for the loan. Conditions are that terms and conditions that you sheet that you get that represent the terms of the loan. And sometimes it can be the conditions of the industry that you're going into. My recommended steps, wherever you work now along that experience line, learn about how your business works, every aspect of it, little to small. I mean, whatever vantage point you have, it can help you when you want to run a business. Build that personal credit score in every possible way you can. Grow your network. That can, give, either through work or volunteering. It can often give you access to people in the industry that you're going into, so you get advice. Obviously research. Google is your friend. Tri-C Library is your friend, Cleveland Public Library, whatever public library is your friend. Grow your knowledge base, again, to show, build that resume, whether it's industry-specific training, certifications, and then, of course, develop the business plan and seek funding. I cease. I didn't know we had a hard close.
Did you want to go through the last couple
Oh, you
slides, Dan, real
disappeared
quick?
there, so I didn't know if I was still on or not.
Oh, yeah, no, you're still there.
Okay. Uh, it's just more slides about SCORE being able to help, which is important, and where you can reach us. And then links. Got a bunch of links here, the several to scores, either local score or national score about that relate to finding funding. The crowdfunding.com, guess what? Talks about crowdfunding. It's good. SBA talks about SBA programs. A couple of the companies that mentions a couple of these firms like ECDI, which does both the microloan and community advantage now, I believe. Growth Capital does 504 loans based in Cleveland. Grants, they're great if you can get them. They tend to be unicorns, though. They're hard to find. If you want to start a nonprofit, the HFLA of NEO website, and then NerdWallet is your friend for sort of those higher cost but accessible sources. Go to NerdWallet. It's very instructive. That's it.
Excellent, Dan. Thank you. If anybody has any questions and you want to throw them into the chat, we'll hang on for a couple minutes. Otherwise, if we don't, then we'll go ahead and close it off for the night. It looks quiet. Okay. Listen, everybody, appreciate it. Appreciate you all joining us tonight and look forward to seeing you on other workshops coming up in the future. Go to score.org/Cleveland and check it out. Thanks much, everybody. Take care.